makers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Monday morning on The Pulse. I'm Manish Cranny in Dubai with the conversations that matter. Here's what's coming up on today's programme. European shares follow the gains in Asia after China announces measures to win back investors, including cutting stamp duty on stock trades. Fed Chair Jerome Powell has the bond market exactly where he wants, lacking conviction about the Fed's next steps as he signals the US could hike again. Plus, ECB President Christine Lagarde warns of three key shifts in the modern world and how they could impact the global economy. More from our exclusive interview coming up. Let's take a look at the European markets for you. So China has rolled out a playbook from the crisis of 2008. Does that fill you with angst or does that fill you with hope? Right now, the equity markets in Europe are taking a slight cue. There was a massive bounce in China's equity market, but that rally has fizzled. You're looking at this 2008 playbook, emergency playbook from the Chinese. The question is, for Europe, it's more about what happens next from the ECB, one could say. Powell talked about navigating under the stars, but the mist still surrounds the ECB's next move. Lagarde remains pretty clear. Undefeated is the word that she used for inflation. Euro dollar at 108.09. We saw the euro trade above the 200-day moving average on Friday, the close of business. One could say that the drop in the euro and the rally in the dollar is much, much more to do with a dollar strength on the rate differential narrative than it is to do with anything else. Across the assets this morning, this is what we've got. It is bank holiday at home. If you're getting ready to go to Notting Hill Carnival, I remember it well. I remember it very well, and I do miss it. But here you go. Much more mundane issues like the value of a two-year yield. 2 years popped by 7 basis points. You'd hardly call that an unmooring of yields by Powell on Friday. But they did pop by 7 basis points. The yuan, you're seeing the dollar up, the yuan down. Is there more of that to come? The MLive survey before the action over the weekend in the stock market saw the yuan tumbling another 4% as there will be a new China sell-off. Standard Chartered, however, say 7 is the ticket price that they see for the yuan in the next 12 months. The Aussie rallied, but is it rallying more on a stronger retail sales than it is on a China stimulus story? And I just put in the MSCI Asia for you to see the complexion of the impact of this latest move by the Chinese to try and put a floor under equity values or social unrest. You decide. It's more an internal, domestic policy response than something to stymie capital flows out of that economy. But you look at the Aussie dollar, as I say, just flat at the moment. It was a little bit higher. Let's take a closer look at the support measures announced by China. Ven Ram joins us. He is our newest resident of Dubai and the MLive team. We're growing.
We are, aren't we? I mean, it's a great office here.
It is. It's rock and roll. Welcome. I hope you have a pretty good time.
Thank you.
Right. Let's get on to the quality of this stimulus. It's just another bucket on a fire, isn't it? It's just a domestic. I read this as a domestic stimulus for the domestic population of China, and I don't think this will do a lot to stop the rot of capital exodus. Your take?
Absolutely, Manis. I think, as you said, bucket of water on a raging fire. I would say Band-Aid on a bleeding artery. Look, I mean, this is all it's called the right optics, right theatrics, but that's what it is, because they are not addressing the malaise that's confronting China's economy. What are the issues confronting China's economy? We have got an economy that's on the cusp of a deflation. That's a major statement for an economy like China. You've got youth unemployment surging. You've got the property market in the doldrums. And so they've got these various issues, and they need to do something that revives the real economy, not the stock markets. The stock markets just reflect what is happening in the real economy.
We're just gonna take a pause for thought. Let me just give you. We're just going to turn our attention. Ven is going to put his microphone. It just dropped off there. We'll get back to Ven in just a little moment from the MLive team here in Dubai. My guest is Lauren van Biljon, Global Fixed Income Portfolio Manager at Allspring Global Investments. First of all, Lauren, welcome. It's great to have you as part of the Pulse on your first on your first outing. We're listening to Ram. He's talking about a plaster on a bleeding artery in China. I think it's much more a domestic kind of fix. Your first take this morning, it's another measure by China to try and put a floor under equities and to stymie the exodus and imbue a sense of confidence. As a global fixed income portfolio manager, does it do any of that for you this morning?
Well, I think your point stands. It's not aimed at the global fixed income portfolio managers. It is very much to do with domestic households, domestic dynamics, probably even social cohesion and security. So for a rates manager, maybe not a wildly optimistic move, although I suppose something that brings stability is always going to be welcomed in the bond front. But we're not a target audience. I think that's the right point to take away from this.
Well, let's play to your portfolio, which is global fixed income. Here we are. A lot of equity managers come on the show and they go, actually, I can live without China. I don't need the angst. I don't need the distress. And quite frankly, I'd prefer to be elsewhere in the world. When I look at the rates narrative, I'm looking at fixed income rates in China, the highest since July, if I'm not wrong. We're at 2.59% this morning. When you look at the choice of duration that you could have, is there any portion of duration in China that you would be prepared to take? And if so, what would be the underbelly of that? Is it the PBOC reaction function?
Well, certainly China has become a big chunk of both the developed market and emerging market bond indices over the last couple of years. You're talking 10% of the widely used local currency emerging market index, and you're talking, depending on whether it's a global or a ex-US benchmark, you're talking anywhere up to sort of 18% of a developed market benchmark. So you certainly have to have a view. But to the point of your Chinese rates are at 2.5%. Highest in a while, still in global terms, that's become something of an outlier to the downside. Look at what's happened to you could get a lot more bang for your buck investing, say, in the UK or Australia at the moment than you could investing in China. But yes, if you are looking at Chinese markets, which as a benchmark relative investor, we certainly are always looking at them very carefully. It's the PBOC that's going to be that big driving force there. They are setting the stage. They are directing the flows. So you've got to spend a lot of time thinking about them and their reaction function.
How much is this disinflation narrative from China playing out? I know that you have a thesis which is its consensus is that we're in a disinflation. The next step is a disinflation. Whether it's a spiral or not, we can debate. But that disinflation pulse from China can have quite a heady impact on global markets. How bad is the disinflation risk from China?
Well, that's an interesting question because it's difficult. I mean, I think I've already seen the first few articles from various sources talking about China's lost decade a la Japan, which is a big statement. Certainly right now, it's undeniable that China is staring directly down sort of deflation's path. Looking at the longer term forecasts into 2024, those are higher for headline inflation. That probably is assuming some further degree of stimulus, of support, but that's a real divergence between China and the rest of the world right now. Whereas the rest of the world has seen its disinflation for 2023, and we'll probably see more in 2024. China, we're talking sort of a lot of the pain being felt this year on the deflation side, and some prospect for a rebound next year. But it does seem like China's going to be adrift of a sort of 2% handle in inflation for a significant period of time. And that is something to bear in mind.
Well, that's the magic number, isn't it? That they're all chasing out there in Jackson Hole. I'd say if Powell and Lagarde could get a hold of 2%, they'd probably be quite delighted and victorious, which we will return to in just a moment. Lauren, stay with me. Lauren van Biljon, a global fixed income portfolio manager at Allspring Global Investments, my guest on Global Markets. Coming up, we mentioned the name. Fed Chair Powell says they'll move carefully going forward. Given the cloudy skies of uncertainty, we'll digest the comments from Jackson Hole, navigating under the stars with cloudy skies. The theme from Jackson Hole.
We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective.
At this point, we really need to see inflation moving down. And we're seeing early signs of that, but I want to keep rates where they are right now, and then we'll decide later what we do.
In my view, I think that really under-tightening would be a worse mistake than over-tightening a little bit, because we can course correct that.
If you could get inflation down without a big recession, that'd be a major triumph for the Fed or anybody. It'd be virtually without precedent. But we're part of the way down that road, and we've been getting good news. We just have to keep getting good news.
Fed officials are speaking at Jackson Hole Symposium late last week. Around the desk this morning, we have our MLive strategist, Van Ram, and my guest we'll return to in just a moment. I think Loretta Mester's line there very much chimes with what Larry Summers said, which was to not do a little bit more would be the bigger folly of all. And that is the building consensus. The Fed will do more and perhaps do a little bit extra to avoid being lambasted again as having faltered in the eyes of 3% PCE.
Absolutely. I think that they've got way more to go. They've come a long way, but there's still more way to go. The reason being, as recently as 2 weeks ago, researchers at the New York Fed estimated that the real neutral rate in the US economy is going to be 2.5%. And we are talking about the real neutral rate, not the nominal neutral rate. So if the real neutral rate is going to be at 250 basis points, where is the restrictive territory on US rates? So there is a very real chance that the nominal Fed policy rate is going to get to 5.75 or even 6%.
Do you really think that they would touch 6%? I mean, applications are at the lowest since 1995. The PMIs are, underwhelming. I'm trying to sort of be very conservative in the language that I use rather than melodrama, as some people accuse me of. There's a break point coming in this economy, though, Van, isn't there?
There's a break point coming in the economy. We don't know when. There's been a break point coming for the past 1 year, Manus.
Agreed.
So that hasn't happened. And the way the US labor market is so resilient, the Fed wants to see that part of the economy rebalance. And we haven't seen that happen yet. Until that happens, we have got to believe in the mantra of Fed going higher for longer.
Okay, and then staying there, which is what the short end is giving you pricing for at the moment. Van, thank you so much. That is our MLive strategist, now resident in Dubai, Van Ram. We shift time zones, we shift the news narrative, and we talk to different guests. Lauren Van Biljon is our new guest, Global Fixed Income Portfolio Manager over at Allspring Global Investments. What a time to be alive in the bond market. I look at this. There you go. I've got other people saying it for me now. Is that the new neutral rate, the real neutral rate, could be 2.5%. We've got miles to go before the Fed sleeps, Lauren, don't we?
I mean, we say this, but they've come so far already, right? They've done a huge amount in a really short space of time. And we are starting to see cracks in the data. I think we've moved into that part of the interest rate cycle where the Fed talks tough and does nothing and just waits to see whether there's a scary event happening around the corner.
Well, I said, what a time to be alive. It's a long time since you've been able to get a real yield at over 2% on 2s and 5s. It's been an even longer time. It's back in my psyche in 2008, and I really don't want to go back there when you got a decent return on bonds. So do you step in on duration now here and perhaps hang tough, that you might be offside by 50 basis points for a while? But of course, you can be a buyer to maturity, can't you? God bless,
Exactly.
buy and hold to maturity.
Exactly.
So do you load up on duration here?
I think the market has turned a little more cautious on duration, right? I think coming in the first quarter, it was all going to be rate cuts this year, buy as much duration as you can. This is the year of the bond. And sure, we're seeing peaking inflation and growth. We're seeing some weakness and some signs of weakness in housing markets or labor markets, less so in the US, obviously. But there's been a lot slower to play out than any of us were expecting. And as you pointed out, right, we've now shifting our rate cut expectations well into 2024. But
But that's where there's
I
a
think
divorce, isn't there? We're now scaling back the number of cuts that we think are going to come in 2024. There's been quite a shift. We're going to show a chart from the library. So how late will those cuts arrive in 2024? Does PCE need to be at 2% before you see rate cuts?
I think the Fed does have its dual mandate, right? So it's going to depend on what's happening in the real economy. And getting back to the view on duration, right? I think the market had a lot of duration, took a lot of it off. But we are, I think, at that stage in the cycle where being short duration is a real risk, right? Because sure, the curves are really inverted, so maybe you want to play around in the belly of the curve. But hedging, holding duration right now gives you a hedge to downside growth risks. And we could, we've seen a couple of shocks this year already, which the market has dealt with really well, the economy has dealt with really well. But there will be a break at some point, and being short duration here, you risk missing that move in a big way.
Yeah. No, I hear you, and there's definitely this divorce, and it's still there between the market and the Fed on the narrative versus the rate cuts. Lauren, thank you very much. A great first outing on the Pulse. Lauren van Biljon, Global Fixed Income Portfolio Manager over at Allspring Investments. The danger for duration hunters. Coming up, the ECB President Christine Lagarde says the world is going through 3 major changes. The View from her exclusive conversation on Bloomberg.
We are facing major shifts. I'll mention 3 for you. One is there's a complete change in the labor market. There's a complete change in the energy future that we are facing. And there is a complete shift in how geopolitical forces organize our economies. Not to mention in the background the climate change impact on our economies, our life, and the imperative that it becomes, as we have seen during the whole summer, for instance, in terms of major heat waves, major hurricanes, and so on and so forth. So you've got these 3 key shifts and the background of climate change. And we need to address each and every one of these 3, which we inherited from the pandemic, which we inherited from the major supply chain disruptions, which we inherited from the geopolitical tensions that we see developing between the United States, Europe, Japan, and many other countries around the world, in particular China.
I was talking to our Alex Weber out of Frankfurt on this speech, and I want to take the 60,000-foot nature of the speech, and I can't imagine Draghi, Duisberg, Trichet giving this speech. It's original to you. But if I look at clarity, flexibility, humility, your backdrop out years is exactly the same as your backdrop on September 16th, which is the original structure you have is to pick 2 nations, the tension between Germany and the tension with Portugal as well. How do you get to these lofty goals given the fractious original nature of the ECB?
I would disagree with that. I think the ECB and the way it has been constructed is intended for collaboration, for controversies, for debates, but at the end of the day, for large consensus. And this is how I have been operating at the ECB. The fact that monetary policy is really European monetary policy is a plus. We are bound by the same currency, the euro. We exchange the same banknotes, maybe digitally one day.
Christine Lagarde in an exclusive conversation there with Tom Keane at Jackson Hole. And she keeps that raging debate alive. Nagel last week talking about it's now is not the time to pause versus Christine Lagarde talking about the structural changes. This is the shape of global asset risks for you this morning. Equities are higher. There is a floor which has been created by the Chinese, reducing stamp duty. I put it to you that it's a crisis action from 2008 which would imbue a sense of angst rather than sating my inner concern. So equities, as you can see, are doing a little bit better. You've got Sweden, you've got a few of the other markets on the up. Check in on the currency board. You will see the dollar is generally down and is strengthening in the yuan on the back of that news flow. To that extent, the question is, where does the yuan go next? You have the MLive survey, the Pulse survey, which says 7.4. You've got Standard Chartered saying no, 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 no. You're going to see 7 in the next 12 months. The dollar rally will end. That's according to Standard Chartered. You see sovereign bonds just take a breather this morning. You've got yields rising. That's playing the catch-up trade to the US trade and bonds on Friday in Sweden and in China. Across the assets, you have yields coming back in the 2-year, but still squarely above 5%. On Bloomberg, good morning. European shares follow the gains in Asia after China announces new measures to win back investors, including cutting stamp duty on stock trades. Fed Chair Jerome Powell has the bond market exactly where he wants, lacking conviction about the Fed's next steps as he signals the US could hike again. Plus, the ECB President Christine Lagarde warns of 3 key shifts in the modern world and how they could impact the global economy. Very good morning. Welcome to The Pulse. I'm Menace Cranny in Dubai. The Commerce Secretary, Gina Raimondo, has stressed the importance of stable economic ties with China on a visit to Beijing. Addressing Chinese counterpart Wang Wentao, Raimondo said the US seeks healthy competition and has no intention of hindering China's economic progress. Bloomberg's John Liu joins me now to make sense of her visit. Blinken was there, Yellen was there. What has Raimondo achieved?
Well, I think the fact that Secretary Raimondo is here in Beijing says a lot about where the Biden administration is trying to take the relationship with China. There's obviously an effort to stabilize things. You named Secretaries Blinken, Secretary Yellen, also Special Envoy John Kerry for climate change was here earlier as well. There is an attempt by Secretary Raimondo to try and differentiate what are things the Biden administration is doing because of national security concerns versus the economic relationship. Whether or not she can convince the officials here in Beijing that the U.S. wants a good economic relationship or not beyond national security concerns, we'll have to wait and see.
What else is on the agenda? I mean, we've had the headlines about standing firm on certain issues in regards to security, but what else is on this agenda?
Well, we do expect Secretary Raimondo to speak to a number of American companies that are here doing business in China. That has been a big concern for officials here in Beijing, that companies would be pulling investment out from China. There's a great story on the Bloomberg today about how Apple is diversifying its supply chain around the world, not necessarily pulling out of China, but growing that supply chain in Southeast Asia and India and other parts of the world. And Secretary Raimondo will be speaking to American companies about that and to Chinese officials as well, trying to address those concerns.
Yep, and we're going to dig into that big take a little bit later in terms of the splintering on the supply chain for Apple. John, thank you very much. That is John Liu, our China editor there on the very latest on Raimondo's trip to China. Well, the co-president and honorary vice chairman spoke exclusively just in the last hour.
We actually have the full support of the Didi platform to make sure that it will be one of the leading, the biggest top-selling product in this category. In exchange for that, we actually also will be issuing our shares to Didi to make Didi a small minority shareholder in our Xpeng. And also with that shareholding ownership, we expect Didi to be a long-term strategic partner for us going forward as well.
Yes, and you want that partnership to involve collaboration in a number of areas. One of those is overseas expansion, Brian. I wonder where that focus takes you. Where do you wish to expand along with Didi overseas?
Well, I think Didi has obviously is in a very significant strength in China, but also it has one of the leading mobility platforms internationally, for example, in Latin America, in Australia, and some other markets as well. So we hope to really work closely with Didi in their strong markets for our future products. But I think more importantly, this collaboration is really targeted to connect two ecosystems. We bring smart EV technology, and Didi brings world-class mobility solutions together to tackle a very important segment, which we call A-class compact smart EV segment.
Okay, and thinking about those mobility solutions, a lot of focus on autonomous vehicles globally. How open do you think Chinese regulators are to moving forward on autonomous vehicles at the moment?
Well, I think right now in China, we already start to see the inflection point of smart driving technologies become a very, very important feature in consumer vehicles. For example, when we launched our G6 model a few months ago, we saw the demand for models with high degree of smart driving technology is actually the most favored model versions. And we expect that with continued cost reduction as well as scale, we actually can bring that technology to the 150,000 category, which is where we actually collaborating with Didi on this project. So I think with combined forces, we want to introduce smart driving into the A-class segment. And for that, I think also that a lot of the collaboration will be centered around both the 2B segment as well as the 2C segment, because that's where the volume is going to be.
XPeng co-founder and honorary vice chairman Brian Guo there speaking on the deal to buy Didi's smart car unit. Well, Apple's major suppliers list shows that 80% of its manufacturing partners last year had a footprint in China. Now, the data compiled by Bloomberg reveals just how that could be changing. For today's Big Take, let's bring in Edwin Chan. Edwin, what does the list show about Apple's supply chain? If I delve into my SPLC, is that my starting point? Good morning.
I think that is your starting point. But what our data and graphics team did was actually a really deep dive into a decade's worth of supplier data provided by Apple itself and kind of cross-reference that with publicly available information. And what it shows is, I think, a widely held understanding that there are seismic shifts underway in the global supply chain. And I think several factors are behind this fundamental shift. And one of them is US-Chinese tensions are on the rise. This escalating conflict, I think, is forcing a lot of Apple's suppliers to consider alternative manufacturing locations. And the other shift, of course, stems from sort of China's handling of not just the economy during the COVID years, but also the way it's gone after private enterprise and sort of the regulatory volatility and uncertainty. And I think that's given a lot of investors, foreign investors in China, a lot of pause as well.
So the implications for the countries that are involved, you've got China, you've got India, you've got Vietnam. We saw a story just a couple of weeks ago about scaling up of the supply chain, the friendshoring into India. What are the ramifications? How quickly does this change?
I think it's going to take years, if not a couple of decades, to really feel the impact of this shift, this fundamental shift that's underway. I think India is well publicized because the government there has ambitions to become the next China in terms of becoming the world's factory floor and supporting its own GDP, its own citizens. I think if you look at the story, there's a lot of evidence of on-the-ground benefits to the local populace already. And if things work according to plan, I think the economic benefits of this shift can only accelerate and magnify over time. Again, if things go according to plan.
I suppose in the end of the day, you've got to ask yourself, what does it mean for Apple products? They're already running financing for Apple iPhones. I mean, ultimately, this is the argument, is that onshoring, deglobalization, which is what this is partly about, ultimately means higher prices, does it?
I think in the short term, there are inefficiencies to fragmenting a supply chain that's essentially served everybody well for decades. I think there's going to be some dislocation, there's going to be some adjustments. I think costs will inflate. But the big question you just asked is whether Apple and other brands are willing to pass that cost on to the consumer. And I think we'll just have to wait and see.
Okay, Edwin, thank you very much. Edwin Chain there with the latest big take story. It's on your Bloomberg terminal this morning. Now, Foxconn Technology Group founder Terry Guo announced his intention to run in Taiwan's presidential election as an independent, deepening the competition amongst the opposition contenders for the job. Guo declared his candidacy for next January's vote at a briefing this morning.
Over the past 7 years, I've witnessed Taiwan go from being prosperous to being on the brink of falling off a cliff in many aspects, including the economy, national defense, and foreign affairs. If we don't pull back now, it will be too late to save Taiwan from falling. We had to take down the Democratic Progressive Party.
Let's just bring you one stock which is on the up. 3M gains as much as 4% in pre-market trade, and this is on the front of your day-bake slate. They've reached a $5.5 billion settlement. Of course, this was to do with earplugs. Various people thought that these defective earplugs would deliver a $10 billion settlement. So this is significantly below where some analysts were predicting 3M would end up in terms of the payments that they would have to make. So it looks as if at $5.5 billion to resolve 300,000 lawsuits. And again, this goes back over quite a number of years. It's spread over 5 years. It's probably, I mean, it comes in at probably 50% of where the estimates were for that. There are a number of other contentious litigation issues outstanding. Now, Russian investigators have confirmed the death of the Wagner mercenary group chief Yevgeny Prigozhin in last week's plane crash. They say DNA tests show all 10 passengers and crew listed as being on board were killed when the jet went down, including Prigozhin. President Putin's spokesperson has dismissed the U.S. suggestions that the crash may have been an assassination by Putin himself. Coming up, we'll bring you our exclusive interview with the UAE Economy Minister Abdullah bin Tuq Al Mari on the BRICS expansion right here on Bloomberg.
This membership is a huge for the UAE. UAE has always been in the last 50 years working on the multilateralism aspect. We want peace and prosperity, and with that comes economy and comes trade. Now, joining the BRICS, that will add a lot as well to the UAE multilateralism support to the world. We were actually focusing on our global trade. UAE has always been as a global hub. Our CEPA agreements, with the CEPA with India, with Indonesia, where we're looking at and going to the global south, that's the most important aspect where we are focusing at the moment, and that will grow. Anybody that connected with the UAE on the bilateral trade, where we look at is how can we grow the trade by tenfolds. Last time we mentioned we want to grow by 7% GDP growth. That's an important aspect for us, and while we double down on trade, that will be where we will focus on.
I will come back to the 7% growth in just a moment, because we'll dig a little bit deeper into that. You talk about a focus on the global south. What goes through everybody's mind is that this is a shift. This is a shift to EM and to the global south. It's pushing back against G7, against that US. This is a hedge, perhaps, against your Western alliances. Can it be described as a hedge? There's finance and politics here.
Oh, no, actually that's not. We are focusing on our growth with the U.S. We have grown about $23 billion of trade between us and the United States. That's a growth from $20 billion of last year. There is a huge work that's happening with the West. There's a huge work. We're invited to the G20 every year.
So this isn't some kind of a pivot away?
Not at all. That's actually, I'm visiting the U.S. in October as well, so there's a huge work that we're going to do. And there's a lot of actually focus on the West as well. The UAE has always been a global trade hub. They're always focusing on the world, on peace and prosperity. The dialogue that the UAE is focusing on is how can we bring the world together.
I'll give you a new fact for comms. You're the biggest new importer to join BRICS. 1.5% of global imports come into this country. But look, there's a couple of big questions. I caught up with Jim O'Neill, who christened the BRICS last week, and he said it's madness talking about giving up the dollar. From your economy ministry, when you hear this discussion about a new currency within BRICS, would you support a new currency, a new digital currency? Are you discussing that? Or do you think it's madness to consider an alternative currency within BRICS?
What we, first of all, Jim O'Neill, his ideas on the BRICS was back in the 20 years ago, 2 decades ago.
Yes.
And I think where the focus was on the BRIC, which was about the emerging markets and the global market development. And I think where we're looking at as well is how can the UAE really play a role and towards the new kind of emerging markets. UAE is one of the fastest growing countries around the world, and I think it is the market's growing at 7%. The growth of the UAE's economy is growing at 7%. We want to grow 7% this year. And I say when we go back to trade, we trade as well. Then let's make a differentiation between the reserve currencies and between the trade currencies. And I think that's something which we are focusing on. What makes it easier for trading hubs? What makes it easier to trade globally? That's something where we're going to pivot on.
That was the UAE Economy Minister Abdullah bin Tuq Al Mari speaking to me exclusively a little bit earlier on the accession to the BRICS. Now we have breaking news from China. Again, not only have they cut stamp duty to a level that we haven't seen, an emergency policy reaction back in 2008, but we see again a reaffirmation of this request. China asks some funds to avoid being net equity sales to boost the market. This takes you back to the outflow. We've seen over $10 billion of divestment in Chinese equities. We did rally at one juncture by 5.5% on the CSI this morning. We've trimmed most of those gains back. Global investors sold into the rally, offloading just over $1 billion of equities, of mainland equities, via trading links in the Hong Kong Connect. So again, coming out this morning, this is how China wrapped up the trading session. The Shanghai Composite up 1 1/8, and the Hang Seng Tech, as you can see at the bottom of your screen, they're up 6.9%. Of course, the view is from Morgan Stanley is that we have gorged so much on Nvidia and AI that it could be that the tech rally has run its course for now. Breaking news, again, another move by the Chinese authorities to try and stymie the outflow from the equity markets in China. Well, Saudi Arabia, the Andes International Holding is set to list in Riyadh. It's a deal that's set to be the largest in the kingdom in the initial public offering slate this year. Matthew Martin is in Riyadh. Matthew, the size of this IPO, do we have a context for it yet? I mean, they're playing catch up with the UAE. Dare I say that? Can I bring a wry smile to my face? This is Saudi pushing ahead with the IPO slate.
Hi, Manus. Yeah, as you say, the ADES, this oil and gas driller that the Saudi Sovereign Wealth Fund, the PIF, invested in just a few years ago, is coming to market. They've not disclosed as yet exactly how much they're looking to raise, but we've reported in the past that it could be around $1 billion. So it's going to be one of the biggest IPOs of the year for Saudi Arabia. There's a big slate of other companies coming through as well. We've obviously got companies like Aramco, some of the Aramco subsidiaries as well, hanging around in the background, maybe weighing offerings as well. So this is, I think we should take this as an indication that the government is feeling quite positive about the appetite in the market for being able to digest listings and being able to digest quite sizable listings as well. And we should see that momentum starting to pick up over the rest of this year, I expect.
I can't wait for the Aramco trading side. Maybe when that IPOs, or even just a slither, another slither of Aramco would be quite big. Let's switch gears. Where are you on the football? You're going to have to get a whole new lexicon and language around you about football, what's in, scores. I can see you being a great football correspondent now, off-tracking Saudi Arabia in the various leagues around Europe. What's the story here? Are Saudi going to look large in some of the European Champions Leagues? What's the story? What's the move? What's the hustle?
Yeah, well, as you say, I never thought that I was moving to Saudi Arabia with Bloomberg to become a sports correspondent. But such is the Saudi ambition now that, this is where we've ended up. And to follow on from that point as well, the Saudi ambition is so great, and we've seen the country throwing hundreds of millions of dollars just at football players alone over the past few months. I think the tally gets us up to around $650 million so far over this recent transfer period. So this is really showing that the Saudis want to make a big noise in football. They want to attract all these top stars as well. And then also what we heard from our interview with the head of the Saudi Pro League is that they're also looking at getting Saudi teams into the European Champions League. So far, the head of the head of UEFA has pushed back against this idea. But I think we've seen Saudi Arabia is prepared to spend the money, is prepared to invest the time in negotiating these deals to make sure that these big headline-grabbing plans that they've got do end up coming through. So at the moment, UEFA pushing back a little bit on the idea, but with the will and the capital that the Saudis have, I wouldn't be surprised if we still see it taking place.
I hear you don't get out of bed for less than $1 billion deal anymore. You are the Linda Evangelista of Saudi Arabia reporting. Matthew, well done. I knew you had a great future ahead of you as a sports journalist. Matthew Martin in Riyadh, changing careers and gears in Bloomberg. Coming up, the Zimbabwean president wins another 5-year term in the general election, but there is criticism. It's pouring in hard and fast right here on Bloomberg. The conversations that matter, the insights that you need. It's The Pulse. I'm Menace Crenny in Dubai. The Zimbabwean president has won another 5-year term in elections that international observers say were deeply flawed. Let's get to Jen Zabazadze. She can tell us what the critics are saying. Jen.
Yeah, Menace, good morning to you. As you mentioned, Emmerson Mnangagwa, he has been in office for 5 years, and at this point he's claimed victory in this election as of Sunday night. But as you mentioned, a lot of observers from the European Union, the US and the UK, all saying that this election was deeply flawed, noticed a lot of inconsistencies, voter intimidation that was happening, and that was a lot of the concern about this election. And the reason why this is so important for Zimbabwe, of course, it's a resource-rich country, but also it's a country with billions of dollars in debt, $18 billion, that a number of international organizations were counting on this election to be free and fair, and it doesn't appear that this is so. We're hearing from the opposition saying that they may challenge this, so a lot to pay attention still, but as of right now, Emmerson Mnangagwa claiming victory over this election.
Okay, let's see whether the detractors manage to take this discussion. Jen, good to see you. Jen Zabazadze there, our Africa correspondent for Bloomberg. Up next, Surveillance, the early edition with Simone Foxman in New York and Tom McKenzie in London, right here on Bloomberg.